Here is the sharp question: why did silver just slip below its 100-day moving average for the second time in 3 sessions? Today, Wednesday, August 26, 2026, spot silver is trading near $67.79 an ounce, down almost 1.3%. The 100-day simple moving average sits at $68.31, and silver has fallen back below it. That moving average is a rolling measure of the last 100 daily closes, and many traders treat it as the dividing line between short-term strength and weakness. The immediate cause is a stronger US dollar. The dollar index is up roughly 0.3% after US inflation data surprised to the upside, and because silver is priced in dollars, a firmer dollar makes it more expensive for foreign buyers and pushes the price lower. This has been a Whipsaw week. On August 21st, spot silver hit $69.82, up more than 2.5% on the day, and futures traded above $70, with the metal up over 5% for the week. That rally began after a U.S. Treasury bond buyback announcement pushed yields lower and weakened the dollar. But by August 24th, buyers could not clear the $70 resistance, and silver pulled back after peaking at $69.92. On August 25th, it briefly fell through the 100-day moving average to a 3-day low of $67.43, then rebounded to $68.86. Today the selling has resumed. The key driver is the US PCE inflation report. Headline inflation rose 0.2% month-on-month, above the 0.1% forecast, while core inflation matched expectations. That headline surprise gave the dollar enough of a lift to knock silver lower. For traders, the impact is technical and psychological. The 100-day moving average at $68.31 is now immediate resistance, sitting just above the 38.2% Fibonacci retracement at $68.02. Below, initial support is near yesterday's low of $67.43, followed by the August 20th low at $65.64. The relative strength index is around 60, which means momentum is still positive but far from overbought. In other words, this is not a broken market, but it is a frustrated one. FX Street noted that the upside surprise in headline inflation lifts the dollar modestly, while repeated rejection near $70 keeps the upside limited. At the same time, silver's fundamentals have not disappeared. The market is heading for a 6th consecutive annual deficit in 2026, with a projected shortfall of roughly 46 million ounces. Looking ahead, the next move depends on whether silver can reclaim and hold the 100-day moving average. The CME FedWatch tool puts the chance of the Federal Reserve leaving rates unchanged in September at about 65%, because core inflation matched forecasts. That suggests the dollar may not get a sustained boost from this report, but silver also lacks a clear dovish catalyst right now. If buyers fail below $68.31, the path opens towards $67.43, then the $65.64 area. A decisive push back above $70 would be a much stronger signal, bringing the 50% retracement near $72.10 and the 200-day moving average near $72.31 into view. For now, the bond market remains the referee. The takeaway is clear. Silver's longer-term supply deficit and positive RSI are real, but the 100-day moving average is the line in the sand. Until buyers reclaim $68.31 and break $70, expect choppy, range-bound price action. Watch the dollar, watch the Fed, and do not chase the rally below resistance.